this is a very important breakout move, and that the way it happened is likely to be a longer lasting trend. Because if you look at the last 20 years or even 40 years, the gold market peaked out in 1980, and then we dropped and so forth. And each time the market strengthened, we had huge retail participation. In other words, the retail clients, they jumped into the market. This has not happened this time around.
In a study analyzing 50 years of data, the World Gold Council found that gold returned 15% per year on average during periods when inflation exceeded 3%. In contrast, gold returned just 6% annually when inflation was under 3%. This demonstrates gold's tendency to outperform when inflation is elevated. The yellow metal's big moves have many longtime gold watchers perplexed as the metal is rallying, despite economic conditions that should cause it to lag, including equity market strength, a muscular US dollar, and reduced expectations for any rate cuts soon from the Federal Reserve. Renowned economist Dr. Marc Faber shares his comprehensive insights on the current trends in the gold and silver markets and the complexities of global economic conditions. Regarding the ongoing liquidity and inflation impacting gold and silver markets, Faber notes that despite the Federal Reserve's interest rate hikes, ample liquidity remains, evidenced by the rise in precious metals. He explains that inflation affects various segments of society differently, with those holding commercial properties and variable rate mortgages feeling the most impact. Interestingly, over the last 2 years, as the price of gold has risen by an average of 5.91%, U.S. inflation rose by an average of 6.6%. This indicates that while gold lost nearly 1% of its real value annually, it still outperformed stock and bond indices, which lost 5.19% and 11.16% of real value, respectively, on an annual basis. This further supports Faber's view that precious metals remain a crucial hedge against inflation, highlighting the resilience of gold and silver in preserving value amidst economic turbulence. While arguing that the official inflation rates are understated, Faber sees the climbing gold and silver prices as indicators of a much higher actual inflation rate. Despite the government's vested interest in underreporting inflation to keep interest rates low, Faber predicts that this manipulation of inflation data is rooted in the tendency of politicians to mislead the public for their advantage. Now, we present the clips of Marc Faber's insights from his recent interview with natural resource stocks. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
In general, I think that asset markets, which have continued to go up, and more recently gold, silver, and platinum, and also other commodities, they're telling us that there is still plenty of liquidity. In other words, it is possible that the Fed increased interest rates, but that money hasn't really become very tight. I want to repeat here something that I have expressed in the past. Inflation is a very unusual complex because it doesn't touch all members of society equally. In other words, if you own a commercial property and your interest rates go up substantially, suddenly, as has happened since 2020, then you may have a problem because there is a glut of commercial properties. And with the rise in interest rates, the property value has obviously declined substantially. In some cases, actually, astoundingly. I mean, there are properties that sell for less than half of what they sold in 2018, 2015, and so forth. I have many examples and pictures of these buildings. Actually, at this price, I was kind of myself interested to buy some because I think they're rather low. But you never know how society changes and whether it's permanent, that people will not go and work in offices anymore and just stay home. And at the same time, there is plenty of liquidity. If you look at the meme stocks that just suddenly rebounded strongly in the last few weeks, and other stocks like semiconductors or Nvidia that keeps on going up, then you can't talk about tight liquidity. And also, you and I, we may be in a different position. The household in America, the typical household has household debts, mortgage debts, and then it depends, how these mortgages are structured. Are these fixed rate mortgages? In the US, you can fix them, I think, for about 15 years. In Canada, you can't. And in Switzerland, the maximum you can fix a mortgage is like 5 years. After they become variable mortgages. The people that have variable mortgages, they are hurt in their income in real terms because suddenly they have to pay much higher mortgages and so forth and so on. The point is simply the rise in precious metals. To me and to other people, it may suggest something different. But to me, it suggests that actually the rate of inflation that we have is much higher than what the statistics indicate, the statistics that are published by the government, because the government has every interest to keep interest rates as low as possible because they themselves suffer under a huge debt and a huge level of liabilities arising from the unfunded debts that they have, the unfunded liabilities. The government has an interest to cheat, and this is in the blood of politicians. Lying, cheating, and stealing. That is in their DNA. They will never publish the true rate of inflation.
During the interview, Marc Faber believes that the recent John Williams inflation estimates correlate closely with rising gold prices and are more accurate than government reports. This suggests the gold market accurately reflects true inflation, indicating potential further increases in gold prices. Williams reiterated that, after an unexpected gain in the PCE and other inflation gauges during the first quarter, policymakers need to see more evidence that price pressures steadily fall before trimming the benchmark rate from its current range between 5.25% and 5.5%. Despite recent fluctuations, Faber asserts the persistent undervaluation of mining stocks and his consistent accumulation of gold without selling, driven by a deep distrust in central bank policies. He advocates for gold, silver, and platinum as stable alternatives to fiat currencies. Let's get back to the interview.
This is a very good idea. He has just recently published a figure that is very interesting. Because I've been following John Williams for the last 20, 30 years. My impression was always that he exaggerated a little bit with the rate of price increases that he indicated. In other words, they were usually twice as high as what the government published. But more recently, I think that his figures reflect the reality more than what the government is publishing. But he published a chart, which I think is very important, and you can ask him at the time about it. Published a chart of the gold price and his inflation rate. The gold chart and his inflation rate, the rate of ascendancy coincides precisely. It's very interesting. So I think the gold market and people who buy gold, they smell, and the market is smarter than politicians and fund managers and so forth. The market is what the market is. It goes up. There's a reason. Usually it's liquidity, but sometimes there are other reasons that the market goes up, or sometimes the market goes down. It's sometimes tight liquidity, but there can also be other reasons. But John Williams' chart, the way his inflation figures go up along with the gold price is amazing. If you don't believe me, take a chart and compare the GDX, the gold ETF, gold miner ETF, and compare it to the S&P 500. Or take the GDX, the gold mining ETF, and compare it to the physical price of gold and silver and so forth. The mining stocks are unbelievably depressed, but they were even more depressed, say, 3 months ago. Many have already doubled from their lows or up 50%. Now, yesterday was a disastrous day for the gold miners. Who knows why? The gold price near term is probably a bit overbought. As I said, for the last 40 years, I do not value my gold. I only look at the weight. I buy every month. I never sell gold. I just keep on accumulating. Now, is it possible that I have a bit more allocated to silver or platinum and less to gold. That could be the case. But in general, I think, as I'm not saying a responsible individual, but someone who is cautious and someone who distrusts the people that run the central bank. I distrust them with all my heart because I also know their background and so forth. They're academics and they are essentially working with the government, and the government has puts pressure on them to do things. But anyway, I would hold it. Let's put it this way: if we have a discussion, and you and I would discuss about the U.S. dollar, is it strong? Is it gonna be weak, and so forth? And then I say to you, okay, what would you prefer to U.S. dollars? The yen, the euro, the Singapore dollar, the Chinese yuan, or the Brazilian real or Mexican peso, or God knows what? I would say there is one currency that stands out as the most steady, and that is gold, silver, and platinum. That I would hold as a currency alternative to the US dollar. The other currencies are not much better, and most of them are worse.
Gold has a knack for shining brightest when inflation levels soar, hinting at its potential as a reliable hedge against economic uncertainty. Despite official reports possibly downplaying inflation, the thriving performance of gold hints at underlying pressures. This could signal an untapped potential for gold to surge further. What's your perspective on this divergence between reported inflation rates and gold's resilience? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.